Happy Friday, everybody. Frank Ray here with the National Real Estate Post with our good friend, Barry Habib. Once again, good morning, Barry.
Good morning.
How are you, man?
Awesome.
Good. I'm going to make this quick mention. Carl White's Loan Officer Freedom book. You guys should grab it. It's got all the best strategies, scripts, and plans for you to do more loans and work, not increase your hours. So, and he's got this dialed in. You see the banner on your screen right here. Just right below the video, you can click that banner. Go get his book. Be well worth it.
Oh, really? It's good.
Oh, dude, Carl's always got it dialed. He has got it
Love
dialed
Carl.
in. He has mastered how to do more stuff and not work more hours. He has mastered that. So, we got a lot to talk about. First things first. Third year in a row.
Well, you're
the crystal ball winner. I'm gonna Grant, my editor. Grant, put the picture up. Grant, put up the picture. Now so we're looking at this picture, Barry, and I got to ask you, the middle ball seems to be bigger than the other two. Is it physically bigger, or is it just the way it's put on the desk?
It's physically bigger. Somebody said, as you get older, I guess your balls get bigger. I don't know. Who knows?
Well, those of us are lucky enough to have some balls to you know what I mean? But that's great. Congratulations again.
Thank you, man. Thanks so much. Yeah, it's quite an honor. I'm really humbled by it. So I'm very grateful and appreciative to the folks at Pulsenomics and Zillow for the award.
You've done so well in your in your prognostication. You just do so well at it, and that's why people are tuned into you. And that's why we always tell you guys, we always put the MBS Highway logo down below that you can click and get a free trial started for a couple of weeks, so you don't miss out on anything. So once again, congratulations.
Hey, I missed one last week. We're 2 days early on a signal that we had for a reversal. We admit when we got one wrong, but we had actually there'd been more than 80 consecutive correct calls, and we locked all the way down. But we were 2 days early on a signal that we got. It was a good signal. I would have made the same call because look, you can't go away from your systems, right? You got a system that works. When you're, you're 80-1, you're not going to change the head coach, but you're not going to go 81-0, baby. So we did. We got one wrong there by 2 days, but it happens. This is a really tough market. It's a crazy one. Seeing things change, and right now that's where we are too. People want to know what's going to go on, where's rates going to head. So a couple of things to look for, just real quick. I think that are important for us. For some bad news, we got a death cross. Death cross. What is that?
What is the death cross?
Yeah. We look at moving averages. When the 50-day moving average moves below the 200-day moving average, so that's the average price for the past 50 days. The average closing price moves below the average closing price for the last 200 days. That's called the death cross, and it's usually not good news. So I've got some other things that we have to consider. This is why it's so hard, because you got all this stuff going, all the stimulus. There's this fears of inflation that's going to happen. So that's what's scaring the bond market right now. So the bond market's reacted more negatively than the inflation expectations so far. So a couple of things to look for. In 2 weeks, a week and a half really, you're going to get the Fed announcement as to what they're doing. Will they do the chubby checker? Come on, let's twist again like we did last summer. Well, they did this several years ago. And when they do this Operation Twist, they sell shorter-term maturities, longer-term maturities to bring yields on the long end down, which definitely helps mortgage rates. Now, we don't know if they're going to do it. Talking about this as something that they might consider if yields go away. Those MBS Highway subscribers know we brought this up at the end of November. We said, look for this if the upper end starts moving away. It's starting to move away. Now the media is catching on to this, and they're talking about maybe, just maybe, you might hear something about this in 2 weeks, week and a half from now, if the Fed moves to Operation Twist. That will push yields a little lower. But there is something that I'm very concerned about, and nobody's talked about this yet, but you're going to be hearing a lot about this. Inflation drives interest rates. Inflation's been real low. Rates have moved up on the expectation of a little inflation coming because of the stimulus, but here's really what I'm concerned about. When you look at inflation, it looks at the last 12 months, and that's how you get your year-over-year inflation. That's your inflation rate for the year. Well, as you move into the next month, the month now that is not 12 months old, but 13 months old gets kicked out, right? So you are putting a month in, the most current month with the month that's 13 months old gets replaced. So that change is what changes the rate of inflation. And the comparisons from 2020 for the months of March and April were very low, especially the one for April, which was -0.4%. It is my feeling that when we get this report in May, and I know here we are in March, May seems like it's in the distance, but it's not that far off. You're going to see inflation readings. Remember, the Fed had that 2% target. Then they said, well, we want to average 2%. We'll tolerate a little bit more. But the bond market doesn't seem to be tolerating this, while the Fed might be. So here's the thing. I think you're going to see inflation year over year in a range of 2.5% year over year. We haven't seen that in a long time. And regardless of what the Fed says, unless they buy lots more bonds, I think we might be in for a rocky road in May when we see this year over year inflation of 2.5%. Investors are going to say, you got to compensate me for that higher rate of inflation. Now, let's think further down the chessboard, okay? Because this is our careers here that, we have to think a little longer term. And it helps us strategically to advise our customers. So while, and look, we put this in our forecast. We said, first half of the year, we see rates going up, but then by the end of the year, we see them cycling back down. As these inflation comparisons kind of then level off, as we get into 2022, I think there's going to be no problem with inflation. We'll have extremely low inflation, and based upon the low levels of inflation that we're expecting in 2022, we will more than likely see yields come down. If not, I'm thinking I'm going to use the R word again. We're looking at 2022, 2023 for a recessionary period, which to me looks like after the stimulus wears off, that's probably where we land. And just like all recessions, that brings rates lower. So your opportunities with customers right now are, believe it or not, these rates, while they might have gone up a little bit, you probably are going to have an opportunity in a year or two to refinance out of it to a lower rate.
Let's stay a year or two in the future here based on what you're saying. Any thoughts on the inventory issues with regard to 2022, 2023?
Housing is a tough one, man, because there is, as you know, extraordinarily low levels of inventory. The price gains that we're seeing, they're not bubble-like conditions, but they're starting to make me a little uncomfortable in seeing people, like 10% year over year appreciation. Don't go by the 16% you hear in the media. They don't know what they're talking about. That's median home price. It's not appreciation. Appreciation is about 10%. And I know it's local, depending on your zip code, of course. However, it's sustainable based on the income gains we're seeing. But if the income gains slow down, these levels of appreciation, they're not bubble-like conditions because we don't have the inventory that would support that. But people might put themselves in a position if they bid too far over asking price that it might take a long period of time before the home value gets there. I still see appreciation, but I think that while conditions are unbelievably great in housing, and that's exactly what I've been saying forever, some of these bid over asks that I'm seeing now, I just think people need to think about them a little bit. And while you want to chase a home, yes, I'm all for going after it and winning the bid. But there comes a point in time where you just have to have common sense come into play and at least do the evaluation. That's why we created that bid over ask tool to help people know, is it going to take you 6 months to break even? Okay. Is it going to take you 8 years to break even? Probably not okay.
Interesting stuff. I guess we'll just see what happens. We'll just have to cruise into this. How about, and we'll wrap this up with today's Friday. This is recorded on Thursday. Going into next week, any triggers next week that you're
right after you're watching this, probably you'll get the results of the jobs report, which used to be the biggest market mover, and it's not as much anymore. You're going to get some inflation reports as we head into next week from the CPI, the Consumer Price Index, the Fed's favorite measure, of course, the consumption and expenditure, PCE, but both give us good clues on inflation. I anticipate inflation to be pretty tame on the reading we get now, but it's going to start to escalate as you get the reading for March, which comes out in April, and especially for the one that I mentioned earlier, for April, that comes out in May.
Okay.
Yeah, and if the Fed doesn't step up and buy a lot more treasuries or start with this Operation Twist, we could be in for a little bit of a rockier road in rates. And listen, guys, it's not terrible. Use debt consolidation, focus on purchases. There's so much out there. You just I don't want anybody here watching this to say, oh, it was a great ride, now it's over. It's going to continue to be a great ride if you just shift your focus, that's all.
Yeah, exactly. And that's like yesterday's show. That's right. That's what I talked about with Brian Covey, finding other verticals, other ways. And even on the refinance, in the refinance realm, there's more reasons to refinance than just lower your rate in term, so good stuff.
By the way, one other thing, people have gained 13% appreciation in the past year. Rates are still about 0.25% lower than they were a year ago. So anybody whose loan you did around a year ago that has MI, they're truly a candidate to refinance. It makes a lot of sense to refi that person, get them out of MI, save them a little bit on rate, but it makes sense. And then the equity that people have built up aside from that, they've racked up a ton of debt. Pay down their debt, accelerate their mortgage, lower their term, change their life for the better. These are all things you should be doing. This is what an advisor does. Stop selling, start advising.
Great stuff. Barry Habib, everyone. Thank you, Barry, so much. Always a pleasure having you on the show. Guys, leave us your comments down below. Forward, share, and subscribe if you're meeting us for the first time. We'll catch you later here at the National Real Estate Post. See you, Barry.
Bye.